welcome to this month's Fintech Firebrand. I'm Virginie O'Shea, founder of Firebrand Research, and I'm here to chat to you about this month's Fintech and finreg news. Now, it's been a particularly busy month already for the Securities and Exchange Commission in the US. As we all know, they're very active when it comes to finreg enforcement, and they started the year with a bang. 16 broker-dealers this month were fined a combined $81 million for failing to monitor their staff communications adequately. Now, this is something that has been a big topic of conversation over the last year or so, particularly as we pivoted from working from home, and there was a lot of use of non-standard communications. WhatsApp, Signal, and the like has been a big focus of the regulators. And the SEC notes in its findings when it relating to all 16 firms that there was a lot of engagement in off-channel communications, such as those different applications that I mentioned. So what they called pervasive and long-standing uses of those unapproved communication methods, which meant that record-keeping requirements, which all broker-dealers are subject to, they evidently failed to meet minimum standards for those between 2019 and 2020. So certainly there was a lot of discussion within the particular enforcement action by SEC figures like Kabir Grewal, talking about how the SEC is focusing on trying to ensure that firms are meeting these obligations for surveillance purposes. Obviously, the more off-channel communications that happen, the more likely there is for misbehavior in their eyes. So certainly the likes of insider trading and these things. So certainly we expect to see many more of these enforcement actions going forward. It's been particularly a big focus of the FCA in the UK as well. So certainly there's been a lot of discussion about it across the pond too. And the SEC really has had a busy month in February. It has also passed a couple of new regulations, new requirements, or updated existing legislation, I should say. One being an update, again, that's been pending for Form PF with regards to extending some of the requirements there for private funds and more in-depth reporting requirements. The other is a slightly more controversial topic related to registration or the classification within the US Treasury markets for what the SEC calls dealers or government securities dealers. So it has actually updated the requirements for these entities. It's extended the obligations related to liquidity providing roles. So firms have to register with the SEC, they have to become members of a self-regulatory organization, and they have to comply with extra laws, obviously. Now, the reason this is controversial is because the extension of the definition here has captured some large hedge funds who were previously outside of reporting obligations, certainly didn't have to comply with some of these relatively onerous and costly requirements. So there's been a lot of debate about that within that particular buy-side community and the long-standing impact of them becoming dealers in the eye of the SEC. Now, there's been a lot of pushback. A lot of the associations have talked about this, have been feeding back to the SEC that they are unhappy about the extension, but certainly it looks like that they will have to comply going forward, and there does not seem to be any leeway, I'm afraid, for now at least, anyway. Another interesting regulatory development, this time in Italy, in a specific European market. There are some relatively controversial rule changes. The Capital Markets Reform Bill that was passed, or it's passed another hurdle within the Italian government this month. The bill itself is relatively controversial. It's attempting to attract more business, more listings business back to the stock exchanges based in Italy. There's a real focus at the moment within the market to try and claw back some of the business that may have gone elsewhere to other markets like the Netherlands. They want to see a lot more foreign investors and obviously foreign issuers coming into the market, as well as domestic issuers that may have moved to other markets. So what the bill actually does is it allows listed companies to issue shares that boost up to tenfold the voting rights of long-standing investors. So it's obviously a big change to corporate governance market practices, and it's a focus on sort of making sure that I guess long-standing investors in the market have more of a say if they've been there for a while and they've been investing in those particular companies for a while. It has angered a lot of asset managers, including a lot of the foreign funds, unsurprisingly, who favour a more direct one share, one vote model, which is the standard. So the argument obviously is that by giving advantages to one particular type of shareholder, you actually concentrate power in the hands of those shareholders, and that is unfair in terms of the overall democracy of the process. So certainly interesting to see that this has progressed so far. Corporate governance is a topic that Firebrand follows relatively closely. We've obviously got the SRD review, the Shareholder Rights Directive review process going on across at the European Union level at the moment as well. So big moves there. So certainly we'll be keeping our eye on governance as it goes on throughout the next 11 months. Now, there's also some interesting discussions within the US House Financial Services Committee this month. That was at the start of the month when US Treasury Secretary Janet Yellen was testifying before or discussing with the House Committee on various topics. Obviously, Basel Endgame was a big topic. There was a vigorous debate on that topic, but certainly another popular area of FinReg that we've been talking about is the proposed changes by the SEC to the US custody rules that many feel will disenfranchise or disadvantage, actually do a disadvantage the digital asset community, because it deters traditional custodians from offering custody to digital asset services or digital assets to support digital assets, I should say. So certainly that was an interesting debate there. Seems like Yellen is very much not in favour of those reforms. So it will be interesting to see how they proceed with the SEC. Certainly the SEC has a huge amount of work ahead of it. And as I've mentioned before, we've got a US election, which will change the dynamics around the SEC once it happens. Interesting to see who wins on that front as well. But certainly that may spell the end of the SEC as we know it, in terms of if it turns over to the Republicans. There have been some very aggressive proposals to change the makeup of the SEC itself. So certainly an interesting year from that front, but there are many rules out there that are up for discussion over the coming months, and we are keeping a close eye on what happens with the custody rule in particular. Some very interesting research this month on ESG, or sustainable development goal branded funds from ESMA, which really relates to sort of mislabeling and greenwashing, as it's called. The particular research piece, it's a paper rather than a proposal or a consultation. So it's highlighting its study of SDG funds within the EU. And one of the key findings was that SDG funds, as they're currently labelled, do not seem to display greater alignment with the UN SDGs compared to non-SDG funds. So essentially there is little correlation between the impact of these funds on the Sustainable Development Goals themselves, or correlation with anything to do with those particular goals. So quite disheartening to hear if you're an investor focused on ESG, or particularly on the E part of ESG, the environmental side of things. So and certainly sustainability is a big topic of discussion across the globe at the moment, particularly with regards to how people are meeting net zero targets and the like. So we'll see what, with these findings, obviously indicates that mis-selling is something that ESMA and other regulators are keeping a very close eye on, something that we'll probably see much more about going into the rest of the year. But again, I'm sure it's just the subset. These are just the subset of the funds they're out there under the ESG bracket. So expect much more research from the regulator going forward. Some somewhat disheartening news from the trenches with regards to operations roles within the banking sector. We've seen the results of multiple banks. They've been a little bit disappointing in some cases. And some banks have indicated, such as Deutsche Bank, earlier this month indicated that it's going to slash a further 3,500 jobs globally. So certainly it's not alone. There are many firms out there doing the same. It's going to be a very tight year, as we predicted in our report, looking at what's happening in post-trade this year. There's a lot going on in terms of implementation and not that many people to actually do the job. So certainly hearing this news, not good for the individuals involved, obviously not good for the organizations themselves in terms of preparation. Fingers crossed things will improve on the economic front and people will begin hiring again towards the back end of the year, but it's a bit scary out there at the moment. Now, for my final thoughts, just a precursor for some of the research that we're putting out, which is reflecting some of the things that have been happening in the market. Obviously, the time is ticking down as we get towards the implementation of T+1 in Canada, the US, and Mexico in May. A lot of minds are turning to inefficiencies within the market, obviously trying to improve settlement rates. Nobody wants to take the hit for increased settlement fails for a long period of time. There's obviously a lot of discussion across the rest of the globe in terms of who else will make the move. Will we be having much shorter settlement cycles in markets like Australia and Singapore? There's been talk about instant settlements there. And obviously in the UK and Europe, we've got important discussions going on. There was the European Commission roundtable at the end of last month, where we saw a lot of interesting input from the industry to the European Commission and ESMA about some of the considerations. I'm sure I've already mentioned this, but certainly there are a lot of moving parts on that front. And now something that Firebrand that we're doing at the moment is trying to understand settlement efficiency rates. And one thing that is sorely lacking across the industry, and this comes from regulators, market infrastructures and the like, is data, essentially, when it comes to settlement efficiency. Even trying to understand settlement efficiency rates across one market or multiple markets, let alone at a global level, is relatively difficult. CSDs, when they do publish this information, it generally isn't in a consistent format, so is not easily comparable. I know that CSDR has been aimed at trying to get that data comparable for the regulators, but at the moment, even the regulators are struggling. If you compare the data that ESMA puts out in its Trends, Risks and Vulnerabilities report every quarter or every half year, we're seeing that data changes. Which is reflecting that there must be many gaps that the regulator is filling as it goes along, or it's recognizing that certain data sets need to be altered as time goes on. So certainly, if the data is not available, it's relatively challenging for even regulators to see how is the industry to cope with that. And now we ourselves are trying to benchmark how much it costs to deal with those fails, even if we don't know quite yet how many fails there are across the industry. From a very, very stable viewpoint, we're doing a lot of estimating, as I'm sure the regulators are doing themselves. But we do have a good idea, given labour costs, given the fact that many firms, as I mentioned, are now struggling with staffing and are having to rely on external parties as well, which is pushing up the costs. We are seeing a lot of expenditure on addressing settlement fails when they happen. And now when we move to a shortened settlement cycle, we'll see a spike in fails that may not go down for some time, so we can expect those to cost to go up even further. And we've also got the spectre of in the EU of CSDR penalties going up as well, as has been noted within the CSDR reviews. So lots of things to think about from a settlement efficiency viewpoint, and expect some really good numbers, even if they aren't as stable as the regulators would like them to be in the